Good morning, everybody. Happy Monday to you. Hopefully, you had a great weekend and happy Mother's Day to all the mothers. Hopefully, you enjoyed it. I wanted to give our weekly stats here. So, for last week, we had a total of 83, 82 active listings, up almost 300 from last week. We had 1445 become active, which again is higher than the prior week. 628 closed, a little bit lower than the prior week, and 1363 went under contract, again an increase. So things are definitely active in Denver metro area, which is great to see. Wanted to discuss today mortgage companies. Probably be a two-parter here as there's a lot to discuss. Starts out obviously on the buyer side, unless you're fortunate enough to have enough cash to pay for the whole house. Generally, you'll need a loan. And so you start with the mortgage companies. Actually, probably should start there first. If you have a real estate agent, they generally work with some mortgage brokers they can refer you to. You can start with your bank, where you currently bank. Generally, banks offer the mortgages. And shop around. They're definitely competitive, so make sure you shop around to find the best rate and product. So that's where the variation comes in, to understand all of that and how it impacts you for the time you're going to be paying on that loan. First step is to get pre-qualified, pre-approved. So if you know, try to find out what price range you can get a loan for. And so that'll help identify what price range of houses you can, start looking at. From there, the mortgage companies will give you a pre-approval letter. Give some indication when you do start writing offers that can go with the offer to give the sellers some confidence that you have already started that process and can fulfill purchasing the property if everything else lines up. Within those loans, this is where the product piece comes in. So there's many, many different products. So you really got to make sure you understand those. Some are interest only. If you want to have a little bit lower payment, you can go with the interest only products. The caveat there is you're not paying down your principal. So you hope that it will appreciate by the time you need to sell it and or refinance. So be cautious with those. And then, the other side of the interest only is principal and interest. So those are obviously a little bit higher payments, but you are paying down some of that principal. And then you also have the rates. So rates, also are all over the place. Again, depending on the product, the term of the loan, or the length of the loan, and what company you go with. They do try to compete. They will advertise a rate, as you'll see on TV, here on the radio, as you look on the internet, shop around different rates. Those are truly based on product. This is where they'll say the rates, 3 and an eighth, fixed for 30 years. However, behind that there may be some points you need to pay, and a point is a percentage of the purchase price or loan amount that you're using. So again, it's stuff to investigate. Your loan broker and real estate agent can help make sure you understand all those pieces. And then the time frame to pay it back can range all over nowadays. It used to be the traditional 15, 30-year type mortgages. Now they have customized time frames. So again, this impacts the amount you're going to pay each month. And then in addition to all of that, they can add on this PMI, private mortgage insurance. So if the loan is above a certain amount of the purchase price, generally 80%, that can give or take, again, depending on the product, the mortgage companies will add on some insurance for themselves. However, they have you pay. So it can add $100 or so to your monthly payment. So again, to be aware of that. And then lastly, well, probably some more, but is the escrow. So with purchasing, you have to get insurance, and then there's property taxes. So the mortgage company will add that in. They will get, when you're shopping for a house, you're shopping for homeowners insurance. So they will add on that amount, and then your taxes, they'll look back at the tax records to estimate what the taxes for the year, and then they'll divide that by 12 and add it into your mortgage payment to build that up. So they will pay those insurance amounts and the property taxes for you. So all that you need to keep in mind to make sure you can afford that, plus just living. You still need to live and take care of the property. And that generally what brings over the debate on owning versus renting. That's a very personal decision. Has to do somewhat with the time frame that you think you may be there living in the house. Obviously things will change, but you need to consider how much is it going to cost, how much you're going to pay each month for that time you're going to be there, compared to what it may sell for. Again, a real estate agent can help forecast what they think it may sell if you're going to be there 5 years, 7 years, versus how much you'll pay in rent. If you're in an appreciating market, it can make some sense to buy versus rent. If you're not, it may not. So again, it's a very personal decision, and definitely have those heart-to-heart discussions with your agent. Like me, give me a call. I'll pick up part 2 next week. We'll go as being into your home and life events that can happen, and getting out of that mortgage. So talk to you later. Have a great week. Thanks.